The local economy has performed better than expected in the second quarter of this year. The gross domestic product increased by 1.2% between April and June. This follows an increase of 1% in the first quarter. This is the fourth consecutive quarterly increase, suggesting that the economy is proving resilient in the midst of the COVID-19 storm. The largest positive contributors were transport, personal services and the trade industries. The primary sectors of the economy, that is agriculture and mining, have registered positive growth. The mining sector data for the quarter was not complete as the Department of Minerals and Energy failed to provide the June data to Stats SA. Stats SA says the integrity of the GDP number is not of concern, but says that when the June data does become available, the GDP will be revised. The trade, catering and accommodation industries have also registered increases, while the manufacturing sector and construction sectors decreased in size. Well, for more on this, I'm joined by Sifiso Skenjana. He's Chief Economist at IQ Business. Thanks very much for joining us, Sifiso. This is a better print than was expected. The market was anticipating something below 0% growth. What are the main takeaways from the report for you?
Yeah, the market was expecting 0.9%, but I think these numbers will also reflect some of the rebasing that we've seen, and so it's probably on par in terms of what it was expecting. I think one of the things that are critical to look at here is certainly the fact that we do have a concentrated industry context in South Africa where financial services and business services continue to contribute the largest chunk of GDP as well as tax collection. And I think it talks about industry concentration and talks about our failure, I think, to create a more broad-based economy that is able to have a lot more resilience across other sectors. I think that's one of the things. Second one, I think, is that we've seen that transport and telecommunications performed really well in the back of this quarter. And of course, this digital intensification that we're seeing has driven a rise in e-commerce. It's driven a rise also in the need for storage, etc. And so there's a lot of activity happening in that space. But it's also often a sign that people are back up and they're moving again. And I think that's quite an important signal for the economy in order to ensure that we charter a more sustainable path for growth. But I think those are the certain things that are important to see, is that these are interesting shoots to see of the level of activity that is taking place in the country.
So the report also looks at the expenditure side of the economy. As usual, it does seem as though it's the consumer that's doing better than, say, government and business. What do you read into that particular number?
I mean, in general, the consumer has tended to contribute about 59.4% of our GDP. But also, from a private sector point of view, especially now with, election season coming up next month, companies tend to be a little bit more trepidatious in their investment choices. But I think also we did see gross fixed capital formation increasing. And I think that talks about the investment into capital stock. So as much as some companies will certainly probably hold on some of the investment choices, I think there's some who are investing into the lower growth space that we're in and hoping to take advantage of I guess, the price weakness that we see in some of the subsectors. I think what's also going to be then critical in contextualizing that is that government's got no much capacity to spend much right now. They're fiscally constrained, and therefore we're really going to need to ensure that we socially contract really well with private sector labor and government to ensure that we collectively drive this economy back into sustainable growth.
So given the unrest that we saw in July, and we understand that the damage was to the tune of billions, although insurance will be there for some, but not all of the damage. What sort of impact do you think that will have on the Q3 number?
It will certainly be a dampener for the Q3 numbers. We already saw ShopRite saying that 6 of the stores that were damaged, they're not going to reopen. And that's the kind of things that we're going to see, where people work now are out of their jobs permanently. And I think those are things that are really going to continue to be pressure points for many other organizations who are also asking themselves if it makes financial sense for them to continue operating. We heard from the Reserve Bank governor that the riots, particularly also because they come from the two biggest provinces, Gauteng and KZN, would have wiped out any upward expectations from a growth point of view, all of the gains that we had seen from a surprise upward tick from an economic growth point of view. And I think that's certainly also something that's going to be, a particular pressure point in terms of Q3 numbers. And then when you look at what's happening in the global economy, we saw that the US job numbers underperformed according to expectation. And I think that's certainly going to show some moderation again away from some of the emerging markets. And so there's probably some downward risk for the South African rand, and it makes our exports relatively more interesting. But when we're importing oil, etc., and we've seen petrol prices continue on the increase, I think those are some of the things that are also going to trickle into the price of goods in the country.
Yeah. One last thing, of course, you're quite a young man and you're interested in the area of economics. We're always told that there's a correlation between economic growth and job creation. And we know that in South Africa, for the longest time, we just haven't managed to see that correlation. Even in those years when the economy was growing at about 5% or so, that wasn't necessarily, linked to the way the jobs growth performance was happening. What do you think, when you think out of the box, what do you think needs to be done for growth, for job creation in the South African economy?
Yeah, we saw 13 years of jobless growth, where in essence we did see GDP growth, but the jobs didn't follow at the same pace. And that certainly means that our economy, from a structure point of view, is disillusioned by the kind of labor force that it's receiving. And so simply to answer your question, I think first thing is that young people are at the front of innovation. And so if we're not spending even what we target from an NDP point of view in terms of our gross expenditure on research and development, we're not going to get the kind of innovation happening that is led and energized by young people. What we're seeing, with now what's going to be now called the Cape Town Stock Exchange is, for example, a capital base that's looking and saying, how do we galvanize and step into this digitalizing world and help small and medium enterprises become the bedrock of our economic growth? Because we do have a challenge in South Africa of oligopolistic markets, in essence, which means there are only a handful of big companies that are playing and not enough space for small companies to be crowded in. And so it's really around saying, how do we create a space where we can crowd in smaller businesses and leverage legislation as an enabler, but also to ensure that also the big players create market opportunity for some of the informal guys to actually have market discovery in some of the parallel sectors. So it really is an SME play, that's a starting point. And two, it is an innovation and an investment-led drive from an innovation point of view. I think that's certainly going to create an economy that is able to absorb some of the young people who have historically not been absorbed despite seeing gains in economic growth.
Thanks very much, Sifiso Skenjana. He's Chief Economist at IQ Biz.